Hey friends, Scott Smith with the Smith team at Keller Williams. Wanted to share with you some insights on your mortgage rates and what impacts them. We've certainly seen some ups and downs with the lending and the stock market, bond market recently, and that has got a lot of people asking questions like, what impacts my interest rate and how can I get a lower interest rate? So we've got three things for you to share, and the first is your credit score. Obviously, if you are a good credit risk, the lenders are willing to give you a little bit better rate with that. If you have some things maybe you need to improve on your credit score, those certainly can make a big difference. The biggest thing with that is, when you're a certain credit score lenders, Fannie Mae, Freddie Mac, if you're looking at an FHA or VA type financing, the big swings can be from a 660 credit score to a 720 credit score. And then once you get up into the 800 credit score, which is certainly A plus, that can make a difference between a quarter to even a 0.5%, if not more, when it comes to getting a loan based on your credit score. So most people, when they're applying for a loan, they're concerned about by pulling my credit, is that going to have a negative impact on it? And if you're pulling it for multiple different things, for car loans, for credit cards, for a mortgage, all at the same time, that can certainly have an impact. But if you're applying for a mortgage, it will not have a negative impact on your credit score. But certainly does make a difference if there's some of those things that you can improve with your credit score. That's a whole different conversation that we can have at another time. The next thing I want to share with you is the loan type that can have a big impact on your mortgage, the mortgage rate. And what I mean by that is if you are putting 20% down on a property and using conventional financing that's funded through Fannie Mae or Freddie Mac, those loans are a little bit different in their pricing structure. On the flip side of it, you might have an FHA, Fannie or a Federal Housing Authority for FHA loans. And a lot of people think that those are designated for only first-time buyers, and that is definitely not the case. They've got a little bit more relaxed qualifying guidelines, and you're able to stretch your debt to income ratios a little bit more. Plus, they will also have a little bit lower interest rates. So if we have a conventional loan that might be same borrower, they might be looking at, let's say, a 6.5% interest rate, whereas that FHA loan would be under 6%. Most likely, it's about a 0.5% difference on something like that. Both loans have the ins and outs. That certainly, you want to talk to a qualified lender that understands the pros and the cons of working with the difference between both of those. If you're looking at VA financing, that falls in similar lines with FHA financing. So we just had a client that was looking at using their VA loan. Can be a zero down loan program, and that loan was actually about 0.75% below what they would have been maybe looking at for a conventional type of product, and they can use zero down, so it frees up some cash for them on the flip side of it. So it's a great loan program for the certain types of clients that have access to those things. The third thing I want to share with you that can impact the interest rate is the term of your loan. And when we say term of the loan, that is how long the loan is amortized. So you might have a 20 or 15 year loan if you want to pay it off sooner, or if you've got a 30-year fixed rate mortgage, that can definitely make a difference as well. And what we usually see the difference between, let's call it a 30-year and a 15-year loan, is about a 0.5% difference. Sometimes that can tighten up a little bit, but for the most part, it's about a 0.5% difference. If you want to have the flexibility of paying down your loan faster, we've got some great strategies like making a 13th payment every year, doing a half-year mortgage payment that comes out on the first, half of it comes out on the 15th. That will typically bring a 30-year loan down to about a 21, 22-year loan if you want to try and pay it down faster. Kind of some of those automatic payment plans are really great for people that want to get that loan paid off sooner versus later. So all of those things, your credit score, the type of financing you're using, and then the term of the loan can certainly make a big difference on the type of rate that you're going to have. Obviously, the biggest thing for you is making sure that that budget falls in line with where you are financially. And even more so with that is making sure that you are having a great conversation with a reputable lender. Don't just go to one of those, a call center Make sure that you've got, just like you'd be talking to a qualified attorney or an accountant or a real estate agent, you want to make sure that you're having good mortgage advice, because if you're going to keep that loan for 15 or 30 years, it can have a significant impact by having a better rate and a better loan that's tailored to what you need. Anything you need from us, certainly reach out, 651-777-3434. Send us some direct messages, any questions, or if you've got any ideas for topics, questions that you might have, we were happy to incorporate them. We pull our information, our content ideas from the questions that we get every day from our clients. So if you've got a question that's bugging you or you want to get answered, certainly reach out and we'll be happy to help you out with that. Thanks. Have a great weekend. Take care.